But we'll get in Matt Orton, who is now joining us, Chief Market Strategist at Raymond James Investment. Matt, great to have you with us here. Thanks very much for your time. So just a quick word on the IT results so far. The commentary also is pretty uncertain. We got numbers from TCS, HCL Tech, of course. There will be reaction today. Infi will come later. What's your sense, and where does that leave you with IT names in India?
Hey, good morning, Prashant. It's always great to join, and the results aren't great. It's also not that surprising to have fairly weak results. When we talked a month or so ago when I was in Mumbai meeting with a number of these companies, some of them included the information technology service names. And while they were a little bit more optimistic about what demand might look like a year plus out, the near term was still very, very uncertain. So I think there's still some speed bumps that the sector needs to get over. I think it's going to take at least another quarter or two. And so this is a part of the market that I wouldn't be looking to buy on dips right now because the fundamentals aren't there. But for the Indian market overall, I think there's still a lot of really good opportunities across higher quality single stocks where you are seeing solid demand. You're seeing very strong macro tailwinds, and those are the types of names that I would want to lean into on weakness, like an M&M, for example, like you were mentioning at the start of the segment. That's a name where I've always been a buyer on dips, and I still continue to believe that the fundamentals remain strong, and I don't think any competition from Tesla is going to disrupt their launch of EVs and their ability to have success in the Indian market.
Okay, so that answers the second question that we had, Matt. You made it pretty clear that you still like Mahindra and Mahindra. You don't expect Tesla to really disrupt that market, at least their market, too much. So what else? When you're talking about high growth opportunities here in India, we've always spoken about some of the banks, the large banks that you've liked. Anything else that you're taking a closer look at right now?
Yeah, Surabhi, some of the cleanup I've been doing across my portfolios has really included aligning across some of the big thematic drivers of growth going forward. So we've talked about how artificial intelligence can play into this, names that are using artificial intelligence to better enhance margins or find client data or expand. Geofinancial has been a name that I've liked more and more. It's still working across the market. Changes to how people are consuming, so names like 197 Paytm, that's another name that I think continues to look attractive. I've been a buyer of that on dips. There haven't been too many of those over the past number of months, but that's another one that I think analysts have not liked for a long time. And you continue to see the name beat that, and people have to catch their expectations up. So I think there's a lot of opportunities across, more unique types of names, and also weakness across travel. After the Air India travel, you saw a little bit of a sell-off to Interglobe, but that's another very high-quality name that continue to order a number of new planes, and they fulfill those orders and continue to place more. And so when I look at where the fundamentals stand there hasn't really been that much of a dent to actual travel. And when I listened to what Delta in the US was talking about last week when they reported earnings, you haven't seen too much of a change. So that's another part of the market that I like to buy on weakness.
Hi, Matt. Good to see you again. Matt, so in terms of the entire global equity setup, it appears that India is standing out for you, and you have been maintaining that stance as well. So if you were allocating fresh money to the global equity markets, how much does India get and how much the rest? If you could just break that up for us. First, if you're allocating money between debt as well as equity and gold, and then in fact, within equity, how much does India get?
Yeah, great question. And so when I look at the portfolios today, fixed income isn't as compelling as it used to be as a diversifier, particularly US Treasuries, given some of the uncertainty that's out there at a macro level with respect to the Fed, the Big Beautiful Bill Act that was passed. That's going to benefit equities much more than fixed income for right now. But I like gold as a diversifier. If you're concerned about volatility in the market, I think gold continues to look compelling. You still see strong central bank buying, especially from China and Russia. I think there's a number of reasons to have support there. So a couple of percent in gold in a portfolio, I think, is a great way to help diversify. when I look at an equity book overall, which I think one should be overweight equities in this market because this is a risk-on environment and the fundamentals across markets like the US, India, Europe continue to look very, very attractive. So India, for example, in my portfolio represents over 10% weight, which is the largest single country weight outside of the United States. It's very overweight relative to what it is in a global portfolio, but I think the fundamentals justify it. You cannot find the level of GDP growth that India is producing that's expected to sustain over the longer term, along with very solid earnings growth potential that's being realized and continuing to increase with respect to expectations. So I think investors are very underweight to India from a global perspective. And as flows start to catch up, I think that can benefit, especially passive flows with a weak dollar. You should continue to see money move into emerging markets, broadly speaking, which can also benefit India as you see those passive flows start to move into the market. So that's the general setup for how I would look at risk in a portfolio.
Matt, a lovely conversation as always. Thanks very much. Appreciate you joining us here on CNBC TV18.
Thank you.